Good day. I thank you for stopping by and tuning into this channel. I greet you in this day. I greet you in this wonderful time. I'm so excited. Today we're going to be talking about Forex patterns. Though I say Forex patterns, remember that patterns in a chart, it doesn't matter whether you are trading Forex, CFD, indices, it makes no difference because patterns are human psychology. So each and every security or derivative or whatever that you are trading, you are competing or trading against human beings, sometimes robots, as we find ourselves in this era. So I want you to join us. I want you also to watch this video. Do not skip through, because each and everything that we cover is very important. We're going to be talking about Forex patterns, and I want you to stick with us. Watch this video till the end, because I have some great offers for you. I have some great offers. If you watch this video till the end, you will get some great rewards at the end. So please join us. My name is Proqnosiz. I also go by the name Alpha Wolf Forex. I represent currency market execution. I am so excited. Let's not waste more time. Let's dig right into Forex patterns. I made so much money using this patterns that I'm going to show you, so I hope that it does the same for you and you remain profitable. Let us go. Before we go, I forgot to tell you, please don't forget to hit like if you like this video. Don't forget also to subscribe to this channel. If you are into Forex, if you're into CFD, if you want to increase your knowledge, if you want to learn more, if you want to learn more tricks, if you want to get better at Forex trading, at CFD trading, at whatever, as long as you are in the currency markets and trying to make money and trying to change your life through currency markets, please subscribe to this video. It will make a big difference to you. Okay, we're going to be discussing Forex chart patterns, né? And then there is 3 different types of patterns. I want you to understand. So we have 3 different types of chart patterns. We have reversal patterns, we have currency patterns, and we have what you call bilateral patterns. So you have reversal patterns, continuation patterns, bilateral patterns. In this video, because I want this to be as informative, and I want you, when you watch this video, I want you to leave here with a lot of knowledge. I want you to leave here. I want it, when you watch this, I want this content to transform your trading, and I want you to leave here with enough information to go and apply on your own. So for me to be able to do that, I have to go in depth. So I'm going to go in depth in this video. So for me to make it, I'm going to cut this into 3 parts. So today we are going to cover reversal patterns, and then we will continue to do other patterns, because I don't want to I don't want it to make like these videos that are all over, that you just watch and then they say and give you maybe 20%. I want to give you everything. So I'm going to cover reversal patterns in this video that you're going to do. So let us go. So what are reversal patterns, or different types of reversal patterns that we have? In reversal patterns, we have double or triple top patterns. We have double or triple top. The reason I'm putting this together, you will see as we continue. We have double tops or double bottoms, triple top or triple bottoms. They are reversal patterns. And then we also have head and shoulders that you're going to cover. And then we also have wedge, falling wedge or rising wedges. I will go deep in this as we continue. I want you to understand that there might be more reversal patterns, but I'm only covering ones that are very common, ones that continue to repeat themselves in your chart, or in your trading. Okay, so let us start first with your double top or triple top. I'm going to explain it and I'm going to group them. So we are going to start with double tops or triple tops. So I'm just going to say double top or triple top. You know that I'm talking about the top and the bottom. I'm going to group them as I explain what they are. So double top and bottom patterns are formed from consecutive rounding tops and bottoms. They are formed after a market attempts to break resistance, support, region more than once, at times 3 times, which makes it a double or triple top. So how do you identify them? You will see them, they form like a W shape. This one will be a double top, and then a double bottom, it's like a full-on W. A double top will be like an M. So this is your double top, this is your double bottom. That's how you identify them in a chart. And you have your triple bottom, which will be three waves, like it's like a W with a V. And then a triple top will be the same but upside down. So I want you to understand they look the same. A double top will be a one that looks like an M, a double bottom will be the one that looks like a W, a triple bottom will be the one that looks like a W and a V. A triple top will be the one that looks like an M and an upside down V. Yeah? So let us go. I always talk about psychology, and most of the time, even when I do these videos, if you look at our channel, I cover 60% of the stuff that I talk about is psychological, because I believe that in Forex, the main driving part of Forex is psychology. The skill is there, the knowledge is there, you have to understand and you have to know what you are doing. But the most important thing is you have to understand the psychology behind each and everything that you see in the charts. So the psychology behind these patterns is traders' exhaustion or decrease of traders in a move. Example, a double top would mean that the bulls are running out of steam and the bears are taking over. The second attempt or failure of breaking the resistance will prove too much and most traders will pull off the move. One, cashing in their profits, resulting in sell orders. And one thing I put in brackets because I'm just gonna go through it. When a buy order is closed or a buy order stop loss activates, the order becomes a temporary sell. The resulting order close of the bulls will signify or invite the bulls. I've explained this in the previous videos, but I'm just gonna put it in graphical format so you can see. You see here the bulls will be pushing up in the market. They will hit a resistance, and then some will cash out. That's what this statement is saying. Some will cash out, take maybe this is an already existing resistance that was previously experienced before. So some will cash out. As they cash out, it becomes a temporary sell. Also, you might find that there are also bears who were waiting in this area to place a sell. So it goes two ways. That's what this statement on top is explaining. And then what will happen? Because there's still a strong bullish momentum, bulls will come again and take control and push the market up. Or you find that these bears here who came here, now they have cashed out. So it's two ways, you understand, in this move. And then the market will go in this previous resistance that is here. And then what will happen? The bulls now, because of this move, and some bulls have cashed out, and then and a lot of bears who are waiting here to confirm this resistance will start coming in, and then you find this type of shape. Well, they will push the market further down. It is a reversal. The market has been on a bullish momentum, has been trading on the upside. So this pattern, you must always spot it when there is a chance of a market to reverse, because this type of shape, it is too common in the chart. But for you to make sure that it is the right shape that you see, you must always make sure that the move is on a reversal. Meaning, if this chart here was coming from the top, or maybe like the bears were already, it cannot cannot be a reversal. It will be a continuation. So this pattern is best executed in a reversal move. At times you'll find that yes, the bears will push down, but in the same previous now support, this is now support. Remember, this area is now support. The bulls will come again and go for the last attempt to push up and fail at this resistance, and then the bears will finally take over. I did this too in different colors because now this can be your triple top. So hence I put triple tops and your double tops in one category because they are one of the same things. It is very important. The reason I do this, I want to show you something. This is now a neckline. This is important when it comes to dealing with your entry and your exit. Now, it is very important to see where your neckline is so that you can, some people enter this pattern everywhere, but you have to have a formula of how you're going to do it to minimize your risk. We are all about minimizing risk. So why is this important? You always look at the neckline. So always try to enter, if it is a double top or a triple top, enter just below the neckline. Why? You've noticed that when I was doing this, when it was still a double top, at this moment you do not know if the resistance, the support will hold. You do not know if this shape will end up being a triple top pattern. So you do not want to enter, maybe let's say you enter at the zone. Why? Because you might try to enter at the zone and this pattern goes up again, so it becomes a triple top, which you will end up being stopped out. Because remember, you want to put your stop level at this zone here, maybe let's say 50% of this shape, 50% of this shape, 50% of this shape. Why? Because you know that if the market pushes up and hit this, most likely it is going to break this resistance, and then you might end up having a big substantial loss. So always wait and confirm your neckline, find where your neckline is, and then enter just below the neckline. Let me just show you in a chart. You can see here the market was trading downwards, which means it was bearish. It came here at a very strong push. You notice how strong this is. It came at a very, very strong push, and it came here, it hit a support. This is a previous support. So this support has always been there. The market pushed up like what we did. This is now a double bottom. It is the same concept. So just like we were explaining a double top, a double bottom is the same concept, just vice versa. So the bears pushed up. They reached a level here, which is a support, and then the support bounced. It bounced off the support, came here, and the bears took control again, pushed it down, but they failed. And I want you to notice something. You saw the previous drawing that we did. It looked all perfect, and everything is perfect, everything is precise. But in the charts, as you go in the chart, it is a bit different because the chart and the movement of the chart, it's a bit messy. So it is important for you to understand how the pattern looks like. That's why I did first the graphical, the visual format, so you can see it, how it looks like, and then I put you in the chart. It is the same concept. And then you see the bears took control, and then what happened? They failed to even touch this resistance and this support. And always remember, a support or resistance, they are regions. They are not like a straight line. It is a region. So this zone here is basically your support. It's a zone, it's a region. So it came here, it even failed to even go, then it posted a higher low. You notice this, it's a higher low, and then what happened? It pushed up. Same concept. What did we say previously? The bears will push down. After they push down, they'll find a support or resistance, and then what happens? The market will push up again. This could be that the bears are taking their profits, they're out, or it could be that you found there was a lot of bulls waiting here, waiting to come in. As they push, you find that there is still a strong momentum, there is still strong bears in the trade. They did not give up. Some were still there, and what happened? They will push it down again, and then they will find this support, or if it's a double top, resistance. What would happen? They would fail, and a lot of them will cash out. And then what happens? There is no more steam, there is no more push to the downside, and then the bulls take control, and this becomes a full-on reversal. Do you notice what we are talking about? Look at here. This is your neckline. Do you see your neckline? It forms a type of, you can say, a resistance. This is your previous support that is here, and then here's the neckline. Here is the neckline here, and which form a form of a resistance. So your entry your stop level will be just half, 50% of this triangle, 50% of this triangle here, and then your entry will be just above. Why just above? Because you do not want to go too early and find that you end up being caught and being stopped out before the move continues. As we see here, look at this chart here, that the market came here and it started trading sideways, and it was giving us spikes. It was giving us spikes in the market. You notice there's a lot of spikes here that maybe if you would have entered too early, it's just that this was a strong bullish push, but sometimes you might enter too early, you might enter here and it can go again and make a triple bottom, and then you'll be stopped out. The reason we are stopping here is because we are always trying to go, when I trade, I go for 1:3, which means I risk one portion and I go for triple rewards. So most of the time you'll notice these patterns, they will always give you 1:2. So they will always give you 1 to 2, so one risk and double the reward. Because how do I usually measure? I usually check at this part here. Most of the time, not always, most of the time you are guaranteed that the pattern after the neckline will move to the length of this zone here. If you notice, this here is the same size as this here, so you would want to make 50% of this your stop loss. As you see, it was so perfect here that your stop loss went right below this spikes. So your stop loss will be here, which makes it 50% of this first triangle, and then you go for double the reward. So it will be from here, and then you maybe exit right just above this arrow. So usually most of the time this pattern will give you 1 to 2 risk reward ratio, but sometimes it can be more. But if it is a double top or a double bottom or a triple top or a triple bottom, it will never be less than that. What I mean is, as it continues to go up, it will not go up and then all of a sudden go down here, you know, most of the time. But you know how trading currency market are, they are very unpredictable. But this is based on human psychology, because as it continues to go up, most people and the other bulls who were here waiting, they will see, there's a confirmation of this move going up, so you will start seeing more bulls come in and push up. Even if you see here, there's still bears who maybe did not close, who maybe were still in the trade, and they are still trying to push the market down, but the bull momentum is too much. So the psychology behind it always tells us that once this neckline is broken, there will always be more players to push this market up. And you don't want to have a turbulent ride. You want to go with the wave. You want to go with the trend. You want to go where everybody else is going. It makes your trading easier, you know, so that you can go in and out as quick as possible and lock in your profits, and then you enjoy your profits afterwards. So that is a double bottom. So I just did this also to show you a double top, same concept on a GBP JPY 30 minutes chart. Same concept, same thing, just like what we said. There's a previous resistance here. The bulls were in control. They pushed the market. They hit this resistance. What happened? The bears came in, pushed it down, because a lot of bears were waiting here, waiting to sell at the zone. Some, they went in early, you know. They're supposed to have waited and seen how the market's going to react. And what happened? The bulls were still available. They pushed the market up again. But this resistance here is a problem for the bulls, because there is a lot of bears waiting here. So the ones who are what we call smart money, they always knew, let us wait and see the reaction. Let us wait and see the reaction of the market, of what happened. And some of the breakout traders were also caught in this move, because some of them, maybe they went in too early, waiting that this is going to break and go up, and then they have their stop loss around here, and then it pushed the market a little bit down. There's a lot of psychological things happening here. As you're looking at the charts, remember, you're looking at people's decisions, you are looking at people's mentality, you are looking at the action that people are taking. It's not just candlesticks moving up and down. There's human behavior behind each and every move. So After that, the bulls came up, they pushed it, and then they've reached this resistance here. And what happened is the bears came in, even the ones who were waiting here and the ones who confirmed. They see that after this, you see it went there and then it started going sideways, which signified that indeed the bullish move is complete. There is no more bull players, and the bears start coming in and pushing the market down. But what do? Do you enter here? No, you do not do that, because you first want to confirm your neckline. You first want to confirm this neckline and then enter below the neckline, because now you know that the pattern is complete. Now you know that the move is gonna continue. Now you know that the bears have absolute control and you are safe, because you know there is not going to be another move going up. There's not going to be another bullish move going up to complete a triple top. So now you look for your 50% of this first triangle, and then you set your stop level just on that 50% of it, which is going to be above this resistance right here. And then your entry, you enter below your neck. You will realize if you entered here, what happened? The market still tried to reverse again, and then now this neckline becomes a resistance. This neckline becomes a resistance, which will push down the bulls if they are trying to take control again. And this is exactly what happened, and the market went down. You notice that this zone here is the same size as this zone here. These are absolutely equal size. They are the same size. So you go for a 50%, you make it. And most of the time I might say 50%, but it's important for you to look at the chart, and you will always see where your resistance or your support is. Just put your stop level just a little bit, a little points, or just a couple of points on top of that support or your resistance, depending whether it's going to be a double top or a double bottom. The same concept you will apply also for a triple top. That is why it is safe to go in below the neckline. Most people would enter here. It is a big risk, because you do not know what the market will do. Will it give you greater rewards? Yes, but you are taking more of a risk. The safer way is to go below the neckline, put your stop level 50% of the initial triangle, depending whether it's your double top or your double bottom. That is the perfect way. That is a smooth way to trade these patterns. And if you want, you can also set, once you see this pattern, you already estimated and you saw the first where your neckline will be, you can set the pending order. You can set the pending order, set your stop levels once you've already seen this shape, and then continue to enjoy your profit. And then as you see, it did exactly the same size here, and then it started doing reversing. So even if maybe let's say you have set your take profit maybe here just below this this arrow, you would have still cashed in, because remember your stop level is still here. So the market never went to your stop level zone, so you didn't even experience any drawdown. And one thing that you've noticed, even on the previous example that you did, the drawdown was 0%. Even here you have 0% drawdown because you entered below the neckline. So it saves you a lot of hassle of watching red zones or your chart trading. I mean your trading on a negative, because you will have 0% drawdown when you do it like this. Can this pattern fail? Yes, because of Forex is not 100%. But do you have a greater chance of making profit with this pattern? Yes, true. More often than not, you will make profit if you're going to trade it exactly the way I'm showing you. And then we have the second pattern, the second reversal pattern. This is very interesting for me. I have my own story with Head and Shoulders. There's a time I believe that this pattern is not effective. There's a time I believe that this pattern does not work. There's a time I believe that this pattern is a fraud. Why? Because I was not trading it correctly. My problem with this pattern is this pattern does not come too often and sometimes take long to form. But this pattern, from my own opinion or my own experience, I've realized that this pattern works best as a reversal pattern. This pattern, if you look at a chart and then you don't look at it as a reversal pattern, you will see it it appears a lot of times in the chart, and then it will always go negative if you're not going to trade it as a reversal pattern. Because I would see this pattern and then I would just trade the pattern without noticing in the charts that is it coming up as a reversal or is it appearing in the chart just as a pattern, you know. So the secret I will tell you is, with this, always make sure that it is a reversal. Make sure that it is reversing the market. If it is not reversing a market and you spot a head and shoulders, then it is not a head and shoulders. So it took me some time to learn, and then once I understood, I've made profits. Matter of fact, this pattern is very accurate. If you're going to apply it the way I show you, it is very accurate. It has 95% accuracy. If you spot it and you apply it, your stop, your entry, the way I'm going to show you, you will benefit a lot, and you can come and testify and let me know how was your experience. So a head and shoulders pattern is a chart formation that appears as a baseline with 3 peaks. The outside 2 are close in height and the middle is the highest. How do you identify it in the chart? You can see here there's a head and shoulders, which is a bullish reversal, and then you have this one, which is a bearish reversal. So you know, it looks the same. It looks absolutely the same, and it has a neckline. Necklines are very important in this reversal pattern trading. So what is the psychology? Like I said, I always like to cover the psychology behind the chart or behind the pattern. So what forms a pattern is when a price rises to a peak and subsequently declines back to the base of the prior up move. Then the price rises above the former peak to form the nose, and then again declines back to the original base. Then finally the price rises again, but to the level of the first initial peak of the formation before declining back down to the base or neckline of chart pattern one more time. So let's do it again. Prices rises to a peak and subsequently declines back to the base of the prior up move. Then the price rises above the former peak to form the nose, and then again declines back to the original base. Then finally the stock price or your currency pair or your, you know, doesn't matter what it is, as long as it's in a chart, rises again, but to the level of the first initial peak of the formation before declining back down to the base or neckline of chart patterns one more time. Like all charting patterns, the ups and downs of the head and shoulders pattern tell a very specific story about the battle being waged between bulls and bears. So the initial peak and subsequent decline represent the waning momentum of the prior bullish trend. Notice the difference. This reminds you of the double top and the double bottom, wanting to sustain the upward movement as long as possible. Bulls rally to push the price back up past the initial peak to reach a new high, the head. At this point, it is still possible that bulls could reinstate their market dominance and continue the upward trend. Hence, it is important for you to spot the neckline. However, once price declines a second time and reaches a point below the initial peak, it is clear that bears are gaining ground. Bulls try one more time to push price upward, but succeed only in hitting the lesser high reached in the initial peak. This failure to surpass the highest high signals the bulls' defeat. This failure to surpass the highest high signals the bulls' defeat, and bears take over, driving the price downward and completing the reversal. So let us look at the graphical explanation of what we are saying. The bulls will push up. They will meet the initial resistance. The bears will take control and push down. They are not in control yet. They are trying to reverse the market. The bulls will come up, dominate the bears, and go up. They will reach another resistance. They've already lost steam with this first one, so which means that some of the bulls have already cashed out. They've already left the trade, and then some of the early bears came and pushed down, and this could also be like what I explained earlier on, the results of this one's cashing out, and then it becomes temporary sell stops, and then it will push the price down a bit, and bulls will take control again and push up and meet this main resistance. And what will happen here? The bears will push it down, and then the bulls will come again. But because the momentum and the steam and the bulls are now few in the game, what will happen? They could only push it to the initial level of the previous resistance, so they cannot now penetrate or dominate or hit this resistance, and you find more bears now are coming in and pushing the price down. That's basically what it is. That's basically what is happening here. That's basically how you would have the psychology of what is going on in the market, and then you can spot this move going on, and you already know that the bears are taking control. What also the other thing that you can notice, you can see here, you've got a high here, and then what happened? The market posted a lower high. The market posted a lower high. Already your eyes are popping up. You can see that something is happening here. Something is happening in this market. And then you can see, okay, let me not go in now. Let me wait and check if this market is going to break the neckline. Once the neckline is broken, I already know that this is a perfect reversal, and I can do what I have to do. What I know what to do is to go in and transact and make money. So fine, and let us look at it in the chart. Again, I said once we draw it there in the graphical and not in the chart, it looks smooth, it looks precise, but you have to understand the concept that I was explaining for you to be able to spot it in the charts. For you to be able to spot it in the charts. I said it usually happens in long term. As you see here, there's a 4-hourly chart for GBP USD. So let us look at it here. What happened? The bulls had control and they were pushing, going up. But you could also see when you look at this chart that the momentum is decreasing. And then they hit this previous resistance. What happened? The bears came and then they pushed down, and then they were still thinking about the move. Some are cashing out, some still believe that the move is going to continue, and what you have more bulls coming in and pushing the market. But now they're failing to break this resistance. What happens? The bears come in and some cash out. This results in this price drop here because of some have left the trade, and some bears who've been waiting at the zone have came in and starting to push up. And you find some of the bulls who still believe that this is going to be a continuation move. They want to continue pushing it down, but there is no momentum because the bears are coming in stronger. And then also this previous resistance at the zone here is still active, and then the bears come in and push the price down. Notice it, they've pushed the price down. This is the same distance as, okay, let me not go before or in front of the horse. Let me take step by step. You notice here is your shape. Here there is your two shoulders, here is your head, and then there's your neckline. There is your initial resistance, and then your last resistance that eventually pushed the market down. This became, after this became resistance, it became support, and then from there it was broken and the bears came and they pushed down and the market moved down. Entry, same thing, wait for the neckline, go below the neckline, go below the neckline. Why? Because you want to be sure that this is a pattern, because if you're going to go up, something might happen. It might look like a head and shoulders, but it is not a head and shoulders until the neckline is broken. So if you're going to enter early, maybe you enter here, you look at this move, and then yes, because this was perfect, you could have still won, but in other instances you would lose, because remember, we are all about making money, we are all about trading, we do not gamble. So you have to make sure that the chances of you winning are higher than the chances of you losing a trade. So you look at all factors that will say that you're going to win a trade before you enter. You don't enter and then think about it once you're already in the trade, because it is already too late. So before you enter, look at all the aspects that are telling you that this is a head and shoulders, all the aspects that are telling you that this move is complete, all the aspects that are telling you that even if there's a slight reversal, you will still win. Now, you will look at the 50% of this as your stop loss, or just above the smaller shoulders, or you can say the smaller triangles, then this will be your stop level. And it is also perfect because it is above the resistance. So once it is broken, you know that no, this market, the bulls have taken control again and the market is going up. Because remember, though it is a perfect head and shoulders, something can happen. The market can be going down, maybe trading stock, and then there's a fundamental news that come up and reverse this pattern. That is why it is always important to also place your stop levels, because there's always external factors that are affecting the market. It is not that you are putting it because you doubt that it is a head and shoulders. Yes, we can see it is, but there are external factors that can reverse the head and shoulders. Just because the pattern is formed, remember, and everything looks like it is, it doesn't mean that 90 or 100% of the time it will go, because there is external factors. This can happen just before major news. This can be forming in a technical chart just before interest rate decision, just before interest rates are released. So it is always important, always very, very important for you to place your stop level just above the zone in case something happens and there's a reversal, that you minimize your losses. So your entry zone will be below the neckline, and then you know that this move from here up below the neckline will always be the same length as this here, will always be the same length. So once you're aware, once you've seen how the chart looks like, you go in and then you transact your cash, you take up profits from the market. Now we have done the double top, double bottom, we've done the triple top, triple bottom, and then we've also covered the head and shoulders. And now we are going to look at the third one in a reversal, which is a wedge. A wedge is a price pattern, but as I continue, I want you to understand that wedge also can appear as a continuation. Wedge can appear in a continuation chart also, but we are going to cover them here in a reversal because they also appear in a reversal. So you have to understand and know how to trade them so that you are safe. So a wedge is a price pattern marked by converging trend lines on a price chart. The two trend lines are drawn to connect the respective highs and lows of a price series over time. The lines show that the highs and the lows are either rising or falling in differing rates, giving the appearance of a wedge as the lines approach a convergence. Wedge-shaped trend lines are considered useful indicators of a potential reversal in price action by technical analysis. Wedge patterns can fall in the category of reversal and continuation patterns, just like what I mentioned above. So always remember that a wedge pattern can fall in the category of a reversal and continuation. When we do continuation patterns, you will see we're going to talk about wedge again and how to spot them. So how do you identify a wedge in a chart? A falling wedge. A falling wedge will look like this. You can see that the trend lines are falling. It's like a wedge. It's like a wedge that is falling. I don't know if you know the shapes of a wedge. Those who used to work in boats, I used to work. For those who don't know, I'm a technician, and then I used to work in the Navy. So we had the wedges in case of an emergency. So I used to work in the Navy, and then whenever I see a wedge, it just reminds me back in those days. Otherwise, we are now here in Forex and transacting money. So a falling wedge will look like this. So it is a wedge. I'm sure all of you know how a wedge looks like. So this is a falling wedge, and this is a rising wedge. So they look vice versa. Yeah? And then you can see here the market was bearish, got stuck in a wedge, and then broke to the upside, which means it reversed. This one, the market was bullish, got stuck in a wedge, and then it broke to the downside, which means it reversed and became bearish. So this is a wedge in a reversal. In a continuation, I will show you when we do continuation patterns. Yeah? So the patterns may be considered rising or falling wedges depending on their direction. So the falling wedge pattern is characterized by a chart patterns which forms when the market makes lower lows and lower highs with a contracting range. That is a wedge, got stuck in a wedge. When this pattern is found in a downward trend, it is considered a reversal pattern, as the contraction of the range indicates the downtrend is losing steam. The rising wedge is the opposite, so it's the same thing, just vice versa. So what are points to remember when I'm trading wedges or falling wedge or a rising wedge? The falling wedge pattern is a reversal pattern formed, again I say reversal, but I want you to understand that it can also be found in a continuation pattern. So the falling wedge is a reversal pattern formed when price bounces between two downward sloping converging trend lines. It is considered a bullish chart formation but can indicate both reversal and continuation patterns depending on where it appears in the trend. So the rising wedge pattern is a reversal pattern formed when price bounces between two upward sloping converging trend lines. It is considered a bearish chart formation but can indicate both reversals and continuation patterns depending on where it appears in the trend. So here we have a rising wedge. You can see here's a nice wedge formation. Here is the trend lines contracting, and then what do you see here? You see the bulls are pushing up. They've reached this level here. The market pushes down and pushes up again. Automatically these trend lines are formed and they are converging. So you find them getting stuck here in this conversion, then you know that there is going to be a move, because this is a temporary move. This shows you that this move is temporary because the market is contracting. So the trend lines are contracting. So what does it mean? It means that the move is temporary and a breakout will follow soon. So this breakout, in a reversal that the breakout will be to the downside, but there's a skill to trade this. So what do? Let me just explain it again. The bulls are pushing up. This explains what I was explaining it in words. Now I'm explaining it in graphic. And then you find that the market is stuck here. It is stuck. The bears and the bulls are stuck in a contracting trend lines. So there is going to be a major move soon. And that major move soon is because here it shows you there's no direction. So you don't know if the bears have took control or the bulls will continue. But if you look at this also and you look at your candles, you can realize that the bears are picking up. The bears are picking up. Why? Because as much as this is contracting, this is also contracting, and this, they cannot break the zone, and then that it's going to fall down. Same thing, you spot your neckline. I didn't draw the neckline here, but spot the neckline first before you enter and confirm the signs of a breakout. Confirm the signs of a breakout, because you can also experience a false breakout. So always wait for the candle. Wait for the candle that broke out of the chart to complete first, because this candle, it can look like a bearish move and then ultimately become a spike, which will trap the bears who are waiting to go in here. So wait for this candle first to complete, and then check the candle that will follow after, and then make sure that you will enter under the support. This is now on a rising wedge, under the support, which will give you that in case the market reverse, you are still safe. Normally, depending, because most of the time wedges are not so clearly defined, even spotting them in the chart, they are not so clearly defined as your head and shoulders, as your double tops. Why? Also because a wedge can also be, a breakout can also come up here, but we'll cover that when we do continuation. So a wedge can be a continuation pattern or a reversal pattern. So you have to always be sure, because there can be a lot of false breakouts, in a wedge. So you have to be sure, use your candle knowledge, wait for this candle that breaks out to finish completing, and gauge how the candle look like. Was that candle strong? Here I see here this candle is very strong. It shows total dominance of the bears, and then what happens is start trading sideways, and then it will continue going down. So your stop level can be right on top here, because this has proved to be a strong zone. This has proved to be a very strong zone which did not break, and then your entry can just be just here. And then after you confirm the candles, and then you go. So a wedge can be a bit tricky to go with a pending order. Yes, a pending order works, but it can be tricky because you can be taken out with a spike. You can be taken out with a false move with a pending order. So the wedge, I would suggest most of the time rather use a market execution, or if you're going to use a pending order, then put your order way below the support zone, because wedge are very common. It's very common for wedge to have spikes, to have false breakout. I will show you. Look here, you can see here it was a wedge for me, not a clear wedge, because in the chart it doesn't look as smart as clean, and look what happened here. This is an example of a false breakout. So you had a early false breakout to trap the bulls. If you're looking at the chart at that time, you see there's a strong bullish candle and another strong bullish candle, which means this candle came here. So for everybody who went in here, who did not wait for this candle first, like I said, wait for the candle that breaks the chart to complete first. So if you're not gonna wait for this candle, and then maybe the market is trading here, and then you enter, you can be trapped, and then the market will take you down, and then you're gonna get stop loss. And then if you're not gonna put your stop loss, depending on your lot size, the market will take you even further down till here, you can even blow your account. So even here, notice here, because I said a wedge can be what? A wedge can be a continuation, or it can be a reversal. So also here, the same thing. A lot of people maybe had pending orders, they got trapped here because you had to wait for this candle to complete. And then once the candle complete, I see no. Here, there is still a little bit of bulls present. So I cannot say I'm going down, because I can see with the spike here that the bulls are still present. So what do? I wait. Now let me just explain to you again. The bears had total control of the market. You can see the two strong candles, and then a wedge started to form. The two trend lines are contracting. And then you had this move here, and then you had a false breakout here, which trapped a lot of bulls who were waiting here, and it took them down, and then some got stopped out, some blew their accounts. And then from here, you can wait and see, is this going to be a breakout to the downside? Wait for this candle first to complete. You can see this candle is not a guarantee. This candle is still a lot of indecision. You look at the second candle, it's a spinning top, shows you that no, something is up here. I think now the bears have run out of steam. The bulls are taking control. Another spinning top here, and then take full control, and then they go up. How would you trade this pattern? This your trend lines that are contracting, and then this move here, which shows you it's going up, will be the same length as the mouth of the wedge. 9 out of 10. That's what's gonna happen. 9 out of 10. This is the same length. It is the same length. So that is going to be your target. Maybe from here you can know that you put your trail stop, or you lock your profits, because there's a high chance of reversal. So you enter just above this trend line. Just above this trend line, that's where you're going to enter. You're not going to enter here because you do not know what is going on. I'll show you why. And then the stop level will be here, because if you enter here, you will jeopardize and you will change your risk reward formula. You will change your risk reward values. So like I said, patterns, most of the time they will give you a 1-to-2 risk reward ratio. Yes, you can get 1-to-3 and so forth, but most of the time, and then you do not want to trade 1-to-1. I don't trade 1-to-1 because, like I said, I always want my reward to be higher than my risk. So that's why I said rather wait for the zone here. Wait for the zone here. Go under above this trend line. Put your stop loss below the other trend line that was trading below at low prices, and then you know that the market, even if it reverses, if it's going to reverse and come down, maybe it was a false breakout to the upside, and then you will be out of the trade, with minimum losses. You don't want to risk too much of your account, and then you will make as much money going up because you would have spotted this, and then you enter. Because look here, if I put my entry zone here, I went up, what happened? The market reversed again. But because my stop level is below here, I was still safe in this zone here. I was still safe, and the market continued to go up go up, and then I cash out here. If I didn't cash out here, I will let it go up again and put maybe my trail stop, or I lock my profits around this zone, and then it went up. Depending if it's a trail stop, how many points I've trail stop, or if I lock my profit, I'll be taken out here, depending on my trail stop, or I could have closed above. So that is a wedge. That is a wedge in a reversal pattern. Remember, I said you have a wedge also in a continuation pattern. So we have covered reversal patterns. What did we cover? We have covered double tops, double bottoms, triple tops, triple bottoms, and then we have covered head and shoulders in a bearish reversal and in a bullish reversal, and we also covered wedge patterns. These patterns are the most common patterns. They are the most common patterns. They appear a lot of times in your chart, but you just did not know how to spot them, or you just did not know how to trade them. This is how I trade them. Trade them the same way. Let me know what you think. Let me know how you trade them. Let me know in the comment section if this information was valuable to you. If you like what we spoke about, please like the channel. If you like this topic or what we covered, or it made an impact in your trading, please like this video. Also, if you want more of this information, please follow us and subscribe to our channel. Hit the notification bell so you can get more information like this. After you subscribe, go onto our videos and then watch most of the psychological part. We've covered a lot of psychological part of trading in our previous videos. Now we're going to go into the technical aspects moving forward. Next up, we're going to be talking about continuation patterns. We're going to cover bullish and bearish rectangles. We're going to cover bullish and bearish pennants, and we're going to talk about continuation wedges. We're talking about reversal wedges. So now we're going to be talking about continuation wedges, and we're going to talk about cup and handle. We're going to look at how to trade them, how to enter them, where to set your stop loss, where to put your take profits, and then after that we're going to look at bilateral patterns. So I promised you an offer towards the end. If you have watched this video till the end, congratulations. It shows that you are very hungry for knowledge. We have beautiful courses that are made up, that we've made specifically with industry specialists, with traders that I trade with, and then we've came up and we've made this course that is going to make a big difference. We have two courses. We have an advanced course which is at 8 weeks. We have 8 weeks access to course materials and mentorship, where I will be mentoring you and showing you how to trade many other things. What we covered here when you're talking about patterns, that's just one of the things that you talk about. So session 1 will have foundational, you have your recap revision, depending if you've already done your beginner or your knowledge, just to get you in a level that you want you to be before you continue with the course, where we're going to cover things like forex trade plan, forex technical analysis and fundamental analysis, forex charting, deep advanced forex charting, forex technical analysis to another level, MetaTrader indicators, to know how to use different type of indicators. What do they mean? Brokers and trading accounts, you cover different types of brokers, different types of accounts, because a lot of people, they just open account. You just want to start trading and you open an account, you don't even know what account it is, you don't even know what type of broker you are using. So this one is for advanced traders who've been trading for some time and just trying, you've been trading for a while, you've been losing, you find it hard to be profitable, but you've been trading for maybe 6 months, 1 year, or even more, and you don't understand it. You start thinking trading is not for you. Believe me, as long as you've been trading for 3 months, it means that in your heart you have the passion for trading, so it is for you. So part 2 will cover forex strategies and advanced trading. I will give you the strategies that I use. So I'll give you fundamental strategies, and then I will give you trading and fundamental trading strategies, forex technical strategy. We're going to cover 5 strategies, 5 tried and tested strategies that work, how to use them and how to apply them. And then on the final session, we'll cover risk management, advanced risk management, advanced trader psychology, your mental, to understand the market. And then we're going to create a trade plan for you, and I'll teach you how to create your own trade plan. And then I will also give you a book for free, which is Trade Forex, the Wolf Way. This is an advanced course. beginner course, what we cover, you have 3 months access to course materials and mentorship. And then it's also separated in 3 parts. It's always best to do it like this. Like I said, this is a tried and tested course, and it is recently upgraded. So we took information from people and asked them questions, what do they like, so whatever they told us, and also we came together and formulated this course. So part 1 is an introduction, which is session 1. This is for beginners. The previous one we did was an advanced. So this is beginners who are just new to Forex, who are interested in Forex, or who just you've been trading Forex for a month, or you've been on a demo, you want to go to live and you want to polish up and ensure that you do understand. Part 1 will cover Forex introduction, Forex terminology, currency pairs, Forex broker, that's currency pairs. It also include currency correlation, trading accounts, currency pairs correlation, MetaTrader platform. We teach you how to use MetaTrader platform, all the important factors in MetaTrader platform, what to look for, what to do, how to set up your charts. And then part 2, we're going to cover charts and technical analysis, which is introduction to Forex charting. You learn about support and resistance, your trend spotting, and then you also going to do like your stochastics, your moving averages, and then your RSI indicators. And then you also learn different ways to place orders, how to place them, where to place them, your limit orders. I know it confused a lot of people. And then you're going to look at pending orders and execution, market execution. And importantly, we never leave trader psychology behind. It is my passion. I've always said that trading is all about psychology, So even as a beginner, we're going to give you risk management. We're going to give you trader psychology. We're going to give you risk management strategies and show you that with risk management, you can even be profitable even though your strategy has a 40-50% win rate. But you can still be profitable. If your strategy has 40-50% win rate and you apply a risk management strategy in that strategy, you will still remain profitable. And I will show you that even if you have 90% winning rate strategy, but without a risk management strategy, that you will still lose. So this the courses that we just upgraded. These courses are available in our website. You will do it at your own time, at your own space. It does not matter where you are. All the materials for the course, all the step-by-step videos are in the website. You just go on the website, you will register, and then it will take you step by step, everything. And for beginner course, we also have an assessment that you do, and once you complete the course, that assessment, do not worry, you will end up passing it. You have 3 chances to pass. If you do not pass, we will come in and mentor you to make sure that you pass. The reason for this is we don't want you to leave the beginner course believing that you are on par, and then you start trading and then you find out you're not ready. That's why we do this, to make sure once you leave, this beginner course will be the only beginner course you ever do in your life. That is the guarantee that we give, because it covers everything that you need. Once you finish with this beginner course, the next thing that you will ever need is an advanced course. Otherwise, because you will be a fully fledged trader when you finish this beginner course. What do we give? I said if you watch this video till the end, I have some goodies for you. I have some goody things for you. I thank you for being with us, for watching this video till this long. It really shows that you do want to learn, you do want to increase. So what I have for you is, we are going to be giving with this video, and it's only limited to the first 30 people. The first 30 people who make use of this coupon, will get 40% off, 40% scratched out of all the courses, advanced or online advanced or online beginner course. 40% slashed. Once you use this coupon, the coupon is available in the description. Just head to the description and check out the coupon. 40% off. And don't worry, if you maybe miss that opportunity, or you say, me, I'm okay with courses, I did enough courses, I just want to trade, but I do not have time to trade. I would like professional traders to go and hold my hand. I want to copy trade what CME is doing. I want to copy trade guys in currency market execution, and I want to take the trades that they are taking, and then minimize risk like they do. If you want to do that, it is no problem, it's okay. You also have an offer for you. I will give you 50% off all 4 different packages that we have. We have a silver package, we have a gold package, we have a platinum package, and we have fundamental package. So we'll give you 50% off if you use the coupon below, but this coupon is only available for the first 100 people. It's only available, so make sure you use it quickly. 50% off all packages for signal packages. Just go to the website, it's here at the bottom, www.currencymarketexecution.com. head over to the shop and then apply the coupon that is available in the description. Like again I said, it is available for the first 100 people. That is a voucher for signals, and then the ones for the courses is 40% available for the first 30 people. So please do not let this opportunity go past you. It's great saving, and you're getting great knowledge for basically nothing. And knowledge, once it's in your head, nobody can take it away from you. If you did not subscribe to this video, please do so. Whether you're gonna buy the courses, or whether you're going to make use of the bonuses or the vouchers, or you say no, I don't want to do that, we still love you. So please subscribe to the channel, so that as you continue to update, as you continue to post more educational material, you can also benefit from it. Do not forget to hit the bell. You hit the bell so that you be the first person to receive a video, so that when we have specials like this, you'll be the first person to make use of it. My name is Mohammed. I go by the name Proqnosiz. I also go by the name Alpha Forex. It was great, and always great being with you. I will see you again with another video. Before you close, please check this video here. Where's my hand? Yeah, check this video here, and check this video this side. It will also help you. Do not let it go past. I'm out.